Welcome to Looking at the Markets with David Modell. I want to discuss mean reversion risk with you today and give you some caution or warning about what could possibly happen in the markets. And hopefully you're not so heavily invested in the S&P 500, Dow Jones, NASDAQ, Russell 2000, that kind of thing, that you're overly exposed to mean reversion risk. And what do I mean by that? Well, if the mean is what's normal, typical, average, talking about an overall trend, okay, what's normal for a long period of time. The longer you look back, the better, because then you have more data to go with. So if that's the mean, the overall average trend, what is reversion? That means going back to that mean, okay? And so if a price or something goes too far above or below the average trend, the mean, if it goes too far away from it, there's a heightened likelihood, or seemingly heightened likelihood, that it'll snap back to it. Okay, it could snap up to it, it could snap down to it. The one that concerns me the most usually is snapping back down to the mean when something gets too far above it. And that is the risk, mean reversion risk, the risk that something that's gotten too far away, too far ahead of itself, will snap back very painfully for unaware investors. All right, so this is chart one of 5 I'm going to show you today. This is number 1, real S&P 500 index, Robert Shiller real price data. And we can see this goes back to January of 1871. So there's quite an abundance of data here. All right, and you could draw a line, and they already did, draw a straight line right through this chart here, going all the way back here. There's no guarantee that it will stay on this trajectory, but if it has, from early 1871 through the early 2020s, I mean, that's pretty reliable so far, at least historically. And when it gets ahead of itself, it has in the past snapped back to it. Might take a while, but look how far ahead it got here, and then a pretty painful snapback. And then look how far above the mean we are here. That is even further above than this over here. This is the furthest above since 1871 on this chart. So the snapback effect could be pretty painful for unaware investors, people who are over-leveraged, over-invested in index funds, that kind of thing. Doesn't mean you cannot buy or own stocks. Of course you can. But I want you to be picky. I want you to be selective. Think about value. Think about knowing what you own. Here's another chart. Arithmetic average annual real return of the S&P 500 over different periods. This is a different kind of chart. It's more of a bar chart. But you can kind of make an average out of this. I would certainly say the average is not 15% returns. That's not normal. Okay, the average might be closer to 10%, 11%, something like that. All right, I see a lot of 8s and 9s here, and a 12, and then 13 or 14, now 15.5 over recent years. I mean, how much can you squeeze out of this? We're not talking about price returns. We're talking about percentage returns. Okay, price returns are going to go up because the price of a lot of things are going up. Okay, but if the percentage returns are going up this much, is this sustainable, or will it snap back to the mean, something more reasonable? And will it take some negative years in order for that to snap back to the mean? That's a valid question, I think. Chart number 3, real S&P 500 index and historical events. And so we have an exponential growth trend. So it's not a straight line, but going back to about 1900 or so, you have a curved line, but it's exponential, and it is a pretty good trend line. They don't always have to be straight. Look at that, okay? So yeah, it's going up. That's understandable. That's fine. But look how far ahead. Wow, the real S&P 500 index has gotten above that exponential growth trend, way, way above. Much higher than even before the dot-com crash and the financial crisis. This is way above that green exponential trend line. Pretty extreme, okay? Yeah, that's a cause for concern. Here's a similar looking one. S&P 500 GAAP, and that's accounting principles, way of measuring things, earnings and forward estimates. And again, when you get too far above, it snaps back to the exponential average here, the mean, okay? Also, when it gets too far below, it could snap up, so that could be a good thing. But look how far above it is, all right? It's too much, in my opinion. And the good old Buffett indicator, and that is named after Warren Buffett, who did talk about it a long time ago, and that is the composite market value to GDP. In other words, the total stock market's value divided by the gross domestic product of the United States, the GDP. And when it gets too high, it could stay high for a while, even for years at a time, but it's already stayed high for quite a while. We finally had a snapback in 2020. We all know what happened then. But now it's gotten so far above, it's started to snap back, now it's back up here again. Pretty wide distance between the Buffett indicator and the historical trend line. So, and this is, again, even allowing for the trend line to curl upwards. Even if we allow for that, still, the actual indicator is way, way above it. Same with this one. Same with this one. Even if we allow for an upward curvature, still way too far above it. So, you know, the next few years even could be pretty scary if we do get that mean reversion. Because how many years of negative prints, annual prints in the S&P 500, Dow Jones, NASDAQ, Russell 2000 would it take to normalize things? And so I recommend being nimble. I recommend looking at value. Are you investing in good value and not chasing after big price moves in things? And are you sufficiently diversified? Okay, you don't have to just own stocks. You can also own gold and silver, that kind of thing. You can own Bitcoin. Be careful with the Bitcoin. Don't go overboard with it, or with anything for that matter. But it's okay to own some of it. That's fine, to balance out other things you have in your holdings. And it's okay to have some cash as well. You don't want to have too much cash at once, because with inflation being still rather high, the value of that cash is going to go down over time. And so if you have nothing but cash and a lot of it, the impact of inflation is going to eat away at the value of it relentlessly. So I hope I gave you some perspective, and maybe consider being a diversified stock picker going forward and for a while. So be careful out there. Thank you so much for watching and listening. I will talk to you again soon.